Well, the little bit of an intraday dip that you got, that's got bought into, and we're back above that 50-day MA on the Nifty. For the first 25 minutes or things have actually looked quite good. You got the bit of a dip, that got bought into, and from the broader markets, plenty of stocks are doing well. Canfin Homes has done a complete U-turn. From the red, it's moved into the green, so that's pretty good news out there. Honeywell has popped back up, and Sonia told us earlier today the couple of upgrades that came on TVS Motors, that's clearly a stock that's doing very, very well. The second day running, Tata Elxsi, well, that's a stock that's coming for selling, and Navin Fluorine as well. The stock that opened up mildly in the green, well, it's moved into the red. But let's focus on V-Mart. Remember, they, disclosure on the exchanges that they bought LimeRoad, which is a fashion and lifestyle pure play online commerce platform. They have bought LimeRoad Business, which is the facilitator between the third-party sellers as well as the buyers. This acquisition will expand the company's presence as an omni-channel fashion retailer and will help them move closer to around that 20% target contribution from online sales in the next couple of years. To understand more about that, we're joined by Lalit Agarwal, the founder and MD of the company. Hi, Mr. Agarwal. Morning. Thanks so much for joining in. Well, focus on this acquisition itself. We've got a broad trend in terms of their revenues. So I want to understand, is this profitable, this venture? And also the second factor is, year to date, what has been the revenue number? Because it's been all over the place. FY20, it was 180 crores. Then we got hit by COVID. So the first 6 months, 7 months of the year, what is the revenue run rate? Go ahead.
Good morning, everyone. This is definitely a very good acquisition that we have had, and this is a great team. LimeRoad, which was run by Suchi, so she's the founder, Suchi Mukherjee, and she has built a great team. And this is something that what we needed, because as a retail, we understand that the more and more consumers are shifting towards digital shopping and digital commerce. And still in the Bharat, the audience that we cater to, we see very low percentage of customers still adopting digitalization as of now. But slowly and gradually, this millennial crowd is definitely going to acquire more and more digitalization. And that's where we are getting prepared for. And that is why we took up this opportunity. And this is a great team, which has a great technology. Okay. And we could really build onto that. But yeah, as far as revenue is concerned, they had a very good peak pre-COVID, and post-COVID, they have gone a little bit down and they have suffered. But as of now, it has a 10 crore plus run rate per month. But yeah, I think we will definitely scale it up immediately within the next 12 months to the pre-COVID levels.
Mr. Agarwal, just the first point, is it profitable? And also you're saying that from 10 crores per month, you want to scale it up. A couple of years ago, it was doing close to around 15 crores per month. Where do you see this scaling up to, and by when?
Couple of pre-COVID, it was doing around 50 crores per month. And I think we could reach to those levels within the next 12 months.
All right. Fair enough. Mr. Agarwal, just tell us a little bit about the thinking behind this. So this is an online retailer, sir? LimeRoad?
Marketplace.
So you've bought this. Will this now be a V-Mart app? I mean, will you brand it as a V-Mart app? Will you change the name, etc.? Or this will remain as LimeRoad?
No, we will continue with the existing assets and the existing customer base that they have. So we'll continue with the brand LimeRoad, and we'll right now bank on that, and that can become the digital arm for all our V-Mart customers as well as the Unlimited customers that we have acquired in the southern India. So both for Unlimited and V-Mart, this is going to be the digital arm. This is going to be the digital commerce.
So all the products at V-Mart stores will also be discoverable via this app.
Yes, definitely, and we'll create an omni experience for the customer who is going to come into our stores as well, and provide them the endless aisle concepts as well.
Won't you have to spend? I mean, the V-Mart brand in the markets that you operate in, I'm assuming is much more recognizable and widely known as compared to LimeRoad. So why would you want to keep these separate? I mean, won't it be, or is that just part of the deal for now?
No, it's not a part of the deal. It's completely dependent on what the business needs are and what the consumer, because the way consumers behave and the millennial crowd behaves, and there are brands which are physically acceptable more. There are brands which are digitally acceptable more. We are trying to do the same thing. We are also trying to test the market, understand the market. We have been trying to do at V-Mart, the vmartretail.com has been trying to promote for the last 3 years. We still have not reached 2% of our turnover. So I think there's a gap between the millennial understanding and the requirements. So we would want to experiment with their strength that LimeRoad as a brand has developed, and we would definitely want to then arm out separately as a brand.
Sure. We do understand that. But, these online marketplaces come with their own challenges, right? I mean, LimeRoad is, at the end of the day, a loss-making company. Of course, it has shrunk its losses over the last 2 years or so. Can you tell us exactly what is the loss on the books right now of LimeRoad? You are taking up a liability of 36 crores. And how do you plan to bring down the costs? I mean, you have done other acquisitions in the past where you have sort of helped bring down costs. What is the plan with LimeRoad itself?
I think, Sonia, I mean, the kind of numbers and the kind of business that Suchi and the team has developed and the kind of efficiencies that they have in the business, that is definitely commanding. And their numbers, this is what I can say, their numbers are better than the comparable players in the market or the best in the market. We could reach to EBITDA positives and profitability in 2 years. There is a loss which is small right now, but I think we could, with the expertise at V-Mart, the product expertise at V-Mart, the qualities that we can offer, and the kind of deliveries that we could offer from our stores, which are 410 doors as of now, where the customer delivery could be much cheaper and much faster. That's the opportunity that we'll try to use and make this system efficient. And that's the real omni piece which will come in and could become efficient and profitable.
So you're saying you can make a LimeRoad EBITDA positive in the next 2 years. That is the kind of timeline you're looking at. For your own company, is this the strategy that you're going to use going forward as well? I mean, are you looking at any more acquisitions? And if yes, what is the cash on the books? What's the war chest that you have lined up?
No, Sonia, we are not an inorganic player. We are definitely an organic player. We do believe that nothing can be brought out. It has to be built. And that's what we are trying to do even with this and the other acquisition that we did in the last year. I think primarily we want to build onto our capabilities wherever we feel that there's an opportunity and we are as a team not so capable enough. We don't hesitate to acquire teams and acquire the particular strength that which is available with the market. So we are not a pure acquirer with valuations. We are a very clear executional team which wants to really work on different areas. Digitalization is one area which we thought is a startup game, and there is a lot of expertise which is required as a brick and mortar retailer. We thought our persona and our behaviors doesn't demonstrate all of that. We are not able to understand the digital customer to the degree which is required, and this team has really done a great job. So we definitely want to build up this culture, wanted to acquire this and do this. So I think this is a great move, and we will not do too many acquisitions. We are not here for acquisition, and we don't plan to do anything more. Nothing is on the cards right now.
Okay, Mr. Agarwal, just to confirm that 10 to 50 crores per month, by when does that happen? In the next 2 years?
I mean, we would definitely want to target that in the next 12 months. That's the potential that we could see. Okay. I don't know. I mean, I'm not a Jyotishi and I can't predict all of that. But yeah, definitely we'll work on this. We've just signed up the agreement. We are going to plan.
Mr. Agarwal, you may not be that, but from a stock market perspective, yeah, you have shareholders and they would like to know what is your outlook. So we're taking that number from 10 to 50 crores, and that's why I ask you that question. And also, you're looking to turn the company around in the next 2 years. We take that on board. You're also looking at scaling up the online revenues to around 20%. Will this be margin accretive or will it come at the same margins? Wanted your sense, I think in the next 24 to around 36 months.
I mean, see, definitely we all know and we all understand the way digital businesses in India is being run and the e-commerce business is being run. There's a huge pump up of money which is happening, and most of the companies are at loss. So it'll be a difficult and tough war and tough field to work on, and that's so getting similar margin is going to be very difficult. I mean, today is a fight for the EBITDA positives, and how do we become that positivity, bring in those positivity, and then fight for that. That may take some 3 to 3.5 years so that we are able to get similar lines. But yeah, what I believe, this is something which is very, very important for the long-term future of our business, for retail, and for our capability building. And this is something which we are working definitely to be relevant even in 2025.
Mr. Agarwal, just give us a sense of how your regular customer is doing as well. Because the general sense is that the lower end of segment across categories is hurting, whereas the premium end is doing very well. Can you confirm that for us? And what's your outlook really?
You are perfectly fine. I can't give you the outlook because we are yet to announce our results. So we would just be able to give you the sense of the consumer mindset. Because in the smaller town and the Bharat, or the real Bharat, where 70% of our population lives, I think, people who earn between 15,000 to 30,000 rupees per month, for them, inflation has really taken a lot of beating and given them a great stress on their budgets. Both the vegetable prices, the raw material, the food prices, the raw food prices has gone up so much, including the energy prices. So I think they are stressed right now. We have seen the stress for the last 9 months, and that continues. But yeah, as festival is coming closer and closer, we are seeing that improvement a little bit more. The stress is getting reduced day by day. But yeah, still the stress continues. And that's the K graph that I have been talking about. The lower capita, the lower per capita income group, the lower per capita geographies, and the customer segment, they are all getting hit. But the metros and the tier ones and the premium customers, they have a lottery and they have a boom. That's the consumption boom which is going to come in.
Okay, thank you for stopping by, sir. All the best with this acquisition. That's V-Mart Retail saying why they bought LimeRoad, and they don't plan to do any more acquisitions in the near future. Today, of course, the stock is up almost about 2% LimeRoad has a small loss, but they have said that they're looking to make it EBITDA positive in the next 2 years. But let's move on. In our special segment, Quarter Se Quarter Tak, today the focus is on the FMCG sector. We have some big guys, HUL and ITC, reporting their numbers this week rather. Mangalam is here to tell us what to expect. Mangalam.
Big FMCG numbers this week. We have HUL, Asian Paints, ITC, Nestle, as well as Tata Consumer, all of them reporting numbers over the next few days itself. But, you know, for the second quarter, it's an insipid quarter that the street is working with for FMCG companies. Why is that? Because of the twin problems. One, weak demand conditions, and secondly, all the companies are sitting on high-cost inventory. So those are a bunch of things that everyone's working with. And in terms of the management commentary that we've got through the quarter as well, you know, weakness in entry-level products is something that the street has to navigate through. And, you know, at the same time, while everyone is looking at this quarter as a bridge quarter between the first quarter of this year and the second half of this year, the second half is important because that is where you're expecting demand as well as margin recovery. So to that extent, this quarter may not be as important from a long-term investor standpoint. But despite that, we have some interesting trends playing out. Titan, for instance, you know, announced an 18% jewelry growth on a high base. So that's telling you that the premium end is doing extremely well, whereas the staples where there is a problem. GCPL, mid-single-digit sales growth with mid-teen decline in EBITDA. You had the same problem with Marico as well. Consolidated revenue growing in just low single digits with no change in the EBITDA. And Dabur as well is showing mid-single-digit sort of growth with a decline of 150 to 200 basis points on the EBITDA. And this distinction is clear in regards with volume expansion, growth expectation as well. For HUL and Britannia, the volumes are expected to grow mid-single digits, slightly below that as well, between 3 to 5, 4 to 5 odd %. Whereas for you know, bigger players, discretionary consumption, Asian Paints is expected a 14 to 16% sort of growth coming in on their business, and ITC cigarette volumes likely to grow by around 14 to 15 odd %. And you know, it is this expectation in the second half which is baked into the price as well, because all these stocks are just around 5 to 6% away from their 52-week high. The FMCG sector has been an outperformer over the last 12 months. It's just Tata Consumer and Asian Paints which have been about 10% away from their 52-week high. Valuations for FMCG stocks have never been cheap, and we continue to see them at elevated levels for most of the stocks, between 37 to 61 times for Nestle. ITC has always had valuation support, currently trading at 21 times, despite the kind of rally that we've seen on the stock.
All right. Thanks a lot for that, Mangalam. Well, we have Abneesh Roy, Executive Director, Institutional Equities at the Nuvama Group, joining us now. Tell us what to expect. Abneesh, good morning. You heard Mangalam out. What is your key expectation this time around, especially from players like HUL and ITC?
Yeah, thanks. This week will be very heavy with results. I think definitely tough quarter for most of the companies, but we expect good numbers by Asian Paints, ITC. Even for HUL and Nestle, the numbers, at least from the pricing growth, should be decent. But yes, margin pressure will be there for HUL, Nestle, etc. But yes, we do expect weak numbers from Colgate and United Spirits. So what investors will be watching this quarter is what is the commentary on rural demand, because it seems that the festival sales are going quite good, but we need to actually wait for the next 10 days for full clarity on that. My sense is in H2, because of the base effect, the rural demand trajectory will improve. But currently, we are not picking up any fundamental recovery in the rural demand. So first half has been very tough. But because of anniversarization, H2 should be better. But I think the real recovery in rural should happen more in FY24. Second, of course, is margin recovery will happen for most companies. I think HUL, Asian Paints, Britannia, these 3-4 companies will be at the forefront in terms of margin recovery. We will have underweight on single category companies like a Colgate, or say even in UNSP, the pricing power is very low. Also, companies which have high exposure to UK and Europe. I think Q2, Q3, both there will be a problem, because there will be almost 500, 600 bips gross margin and EBITDA margin erosion because of very high inflation and forex impact also. So net, the valuation thing which Mangalam said, I think that outperformance of FMCG and the consumer stocks will continue, but Q2 definitely looking quite challenging for most of the companies.
Abneesh, we just had the management of V-Mart retail with us earlier. Tier 2, Tier 3 retailer saying that, what we call Bharat, right? That is hurting. Inflation is really pinching. From a company standpoint, is the full pass-through being happening, or companies are having to absorb some of the sort of input price pressures, etc., although that pressure has come off quite a bit?
Yeah, sure. So if you see, it's a good question. There are 4 points. If you see actual results will come this week, we expect almost all-time high pricing hike of almost 14% of the portfolio. And that has accelerated every quarter. So yes, companies are passing on, but Q2, you will not see that benefit at all, because in Q2, there is the higher inventory. We have seen further inflation in the detergent, raw material, and the food, etc. And there's a forex impact and currency impact also. So yes, H2, we will see expansion. For most of the companies, the expansion will be there in gross margin, 100 to 200 bips for most of the topics we do expect. So coming to the third point on the rural demand and the Tier 3, Tier 4, clearly UP, Bihar, Bengal, and Jharkhand. These 4 states, now there's a new theme, right? Although there is a deflation, say, in fertilizer or say diesel, the new issue is because of a deficit of rainfall of 20-30%, the rice output will be impacted, and in general, agri output in these 4 states will be impacted. So whichever company has high exposure here, I think will be suffering more in terms of growth next few quarters.
I wanted to come back to your point about Asian Paints. You said that the numbers are going to look good this time around. I mean, even last quarter, right, the decorative business picked up in a massive way. I think it was the highest volume growth in the last 5-6 quarters at about 30% plus. You think it can do better than that this time around? And what's your call on the stock itself?
No, that will be tough, because if you remember in Q2, first 2 months were very challenging, in the sense very high rainfall, exterior paint is not really possible. But yes, September month was great because of the festival demand, market share gains, etc. So I would say yes, Q2 should be more in the 12 to 14% kind of a volume growth range. If you see from a 3 to 4 year trajectory, still it is very strong volume growth. But Q1 there was a base effect also, because Q1 there was a COVID in the previous year. But yeah, H2, the thing is, because festival this time is a bit early, paint companies will face this challenge that some of the demand would have shifted to Q2, September month. We are positive on Asian Paints. Yes, second half, we do expect around 150 to 200 bips EBITDA and gross margin expansion for Asian Paints, because most of the raw material has come off definitely. And China slowdown definitely helping in terms of the TiO2 demand and most of the other raw material for Asian Paints.
Okay, all right. And on the gross margin front, I'm sorry I didn't get you, because the persistent inflationary environment was something that was impacting gross margins for a while. You think that pressure is completely off, and what is the expectation, both for Asian Paints as well as the other paint companies?
Yeah, so Q2, you will see slight improvement in margins, gross and EBITDA margins for Asian Paints versus Q1. In spite of the forex impact, in spite of the higher price inventory, slight expansion can happen. H2 is where the gross margin and EBITDA margin both should improve. So Q2, there will not be any significant improvement quarter on quarter. See, YOY it will look very good, because Asian Paints margins in the base quarter was very low, 12 to 13%. So optically, it will look good, but quarter on quarter, we expect slight improvement.
Okay, Abneesh, we'll leave it at that. Thanks a lot for giving us a quick take on what to expect this earnings season. There could be pressure in names like HUL, ITC, but paint companies is something that he likes. Asian Paints tops his list over there. So
now, just a quick word on the market, right? I mean, we are past 17,500 now, so this is getting better and better. So there was a mild stop, I mean, a half-an-hour stop at that 50-day moving average, which did take place. But once that got out of the way, it took 2 tests there. We are past 17,500. Okay, welcome back. The market is flying away, 17,500, almost 200 points in the green. Banks are leading the charge once again. And by the way, PSU Bank Index is up 2%. It was after yesterday's 4% move. So this is a real large move, which is developing in the PSU Bank space. Names like Canada, State Bank, etc., of course, are leading. I can't really spot the private bank space in the reckoning at all today. So Z is, of course, propelling what's happening in the media space. And then there are energy names. Reliance was a late participant in trade yesterday. And Reliance is up another 2% today as well. So that's a large move. Low yesterday was 23.43, and it's moved up 100 rupees from yesterday's low to where we are now on RIL. That's a heavyweight. Mitesh is joining us with some more trading ideas. Mitesh, hi. Good morning. Welcome back. What should one do? I mean, it's looking like it's going to be a strong day. More to come?
I think so, Prashant. We talked about 17,580 and then possibly 17,750, 800 as the target areas. I think we are well on our way to do that. And you were just highlighting Reliance. That's one of my recommendations, with a disclaimer that we have some covered call long bias positions on Reliance. So I think Reliance could now finally start participating, apart from the fact that the banks and IT stocks are doing well. So this market does look like will go higher in the next few days. On Reliance, with the disclaimer, I think the stock is looking like heading towards its 200-day average, which is the target for the timing, around 25.05. And I would recommend a buy here with the stop below 24.35. And the other call which I have is Oracle Financial Services. After a long time, this IT stock has come on the radar. It's a buy with a stop below 29.45 for targets of around 30.50 on the outside.
Okay. In fact, of course, the oil and gas numbers of Reliance may not look too good, but for the telecom space, Jio's numbers are expected to look good this time around. The average revenue per user is expected to go up to almost 180 rupees compared to 175 last quarter. And not just Reliance, you have even Bharti Airtel that's moving up quite a bit. So just wanted to make that point.
Okay. All right. For the time being, let's take a bit of a break from the equity markets and let's focus on the commodity segment. Manisha is joining in to run us through about what's going on in that space. Manisha.
Thank you for that, Nigel. That saying where they say that the commodity prices go up in an elevator and then get thrown off the cliff, and that's exactly what we are seeing in case of the gas prices. I mean, 10% down in this week, and all those concerns about gas really seem to be going away right now. Overnight, we've seen the US gas prices decline by 7%, and that pretty much has been the case with other gas prices also. We are trading now below $6 per MMBTU. The high for this year has been $10 per MMBTU. The low has been $4 per MMBTU as well. So that has been a big range that we've seen for gas there. If you look at the US domestic production, that's at a record highs of 99.9 billion cubic feet per day, and there is lower demand, and that's what's weighing onto the markets there. When you look at the inventories as well, there has been last 4 weeks where we have seen more than 100 billion cubic feet being added. This is the latest data where 125 billion cubic feet has been added to inventories. So good inventories there. And this is just about US. When you look at the other countries, we are looking at higher gas stocking there as well. There is a forecast of mild winter above normal temperatures, and that's weighing onto the prices as well. But this is about US. When you look at the European natural gas prices, they declined by 11% overnight, trading at a 16-week lows. And there were concerns about on whether or not Europe will be able to stock enough gas ahead of winters. So, well, yes, they have 91% of storage capacity filled with gas right now. This is about Europe. When you look at about Germany, the gas storage is at 95% of capacity. Same is the case with UK as well, where you have the prices trading at a 12-week lows. Here as well, when you look at the storage capacity, UK has filled up nearly 100% of their capacity. The UK gas prices now are 60% off its August highs. So the gas really seems to be doing well when it comes to within the storage capacity there. I also want to bring in on what the gas prices have done in this week and this month. As you can see, on a week-on-week basis, 10 to 11% of a decline in US, Europe and UK. And month-on-month basis, we are down anywhere between 18 to 30% here. If the below or the above normal temperature forecast continues beyond November and into December as well, then you are looking at some more profit taking in the very near term.
Okay, Manisha, thanks a lot for that. Well, there are plenty of stocks that are moving around. India Mart is surging now, 5% higher on that stock. You have something like a Sheela Foam, Chalet Hotels, Campus Activewear, Bank of Baroda. The list is pretty long. But let's go across to Nimesh and find out the latest on Z, that big block deal taking place. Nimesh, over to you.
Hi, Sonia. So Z is one of the big gainers in today's trade, and not surprising. The couple of reasons why the stock is doing good today. One, the entire block of 5.5% from Invesco happened in a block window. So there was absolutely no slippage. in the block. I still don't have the color on the book, which means there are not enough details on who the buyers are, and that will be the next important thing to watch out for. Maybe the disclosure will come today evening, so that's something to watch out. The other reason why the stock is doing well today is the fact that now there is 180 days of lockup for Invesco. See, Invesco was holding 10.5% and 1.5%, and they were sold 5.5%. So they left with 5%, but this 5% can only come now after 6 months, so there could be no further supply. And in the 6 months, there is a very high possibility that the new entity will get listed on the exchanges. Post that, any which ways, the Invesco stake will further go down because the equity base is going up. So, there is now no further supply coming in from Invesco, at least for the next 6 months. And the fact that the block happened in the block window is leading to a big surge in Z Entertainment today. As I said, the disclosure in terms of buyers will be important. I don't have a color yet, but the two big reasons why the stock is up today. One, it happened in a block window, and the fact that now there is a lockup for 180 days for Invesco.
All right, Nimesh, thank you very much for that. There is Z, which is doing very, very well. The market's doing very well as well. 200 points on the Nifty as we...
Well, let's stick with equities and to the two big private banks that have announced results so far. Federal and HDFC Bank have both exceeded expectations. HDFC Bank posted a loan growth of 23%. Federal's loans grew 20% in the second quarter. Both banks reported a 10 basis point rise in their net interest margins. Both improved their return ratios. HDFC Bank's return on assets grew 20 basis points to a massive 2.04%. I mean, that's a huge ROE. Federal's ROE rose again 10 basis points to 1.21%. Very good growth even by Federal's past trajectory. Now, is there enough in these numbers to make the market expect an even better performance from other banks that are due to announce numbers like ICICI, SBI and a whole host of other banks? What are the hot favourites to watch out for? And will this bonhomie extend to PSU banks as well? For all these, I'm joined by Suresh Ganpati, the banking analyst at Macquarie Capital Securities. Suresh, thank you very much indeed for joining us. We normally call you at the end of the results season, but because these two results were so good, we thought we would benefit by getting your advice earlier before the bulk of the numbers come. HDFC Bank first. Are the numbers even better than you expected?
Yes, so if you look at this quarter, Lata, I mean, there has of course been a repo rate increases during this entire quarter, and we definitely expected loans to reprice faster than deposits and a margin expansion. So the margin expansion came in line with our expectations. What has happened here is that despite the high treasury losses that HDFC Bank reported this quarter, they still managed to report an overall ROA of about 2.04 or 2.1%, depends upon the way you calculate. So that's definitely better than expectations and clearly shows the strong operating profitability that all these banks are likely to have this particular quarter.
Yeah, we were all expecting lower credit costs. It is just that the loan growth appears to be even better than one expected. And of course, margins uniformly higher for both Federal and HDFC Bank. It's the ROA that takes your breath away for HDFC Bank. Because of this performance in the ROA, which, distills everything, would you raise estimates for something like ICICI or Kotak or SBI? That's still to announce.
No, we cannot, of course, give any forward-looking guidance at this point in time. But having said that, let's put it this way, that we started off the year with almost 50 basis point rate hike. That was the initial expectations and everybody got it wrong. And by the end of the year, we would be starting at closer to 250 basis point rate hike. During this entire rate hike cycle, the one sector which is actually not seen earnings downgrades, in fact, on the contrary, has seen earnings upgrades is financials, particularly banks. So I think the positive earnings momentum will continue. Let's put it this way, that the downside to earnings for the banking sector coming from a sharply rising rates, or for that matter, slowing down of the economy, is relatively much lower compared to any of the other sectors in the economy.
Okay. What's your hot favorite? I mean, I think IndusInd Bank, we are running your EPS forecasts. IndusInd Bank, there's a 50% jump in EPS. Even Axis, I think it's a near 50%, about 45% jump. Would that count as your hot favorites?
So my topic clearly going into the results was IndusInd Bank, and in fact, even from a next 1 year perspective, IndusInd Bank still remains one of our topics. I mean, the way you should look at it is the fact that they were still running at 2% kind of a credit cost as of the previous quarter, and that's way high, right? And with the fact that you're seeing quite a sharp uptick in cyclical sectors like microfinance and commercial vehicles, which is where they're predominantly present, you're going to see a sharply declining credit cost, thereby giving a boost to earnings. So much of this earnings increase that you're seeing specifically for IndusInd Bank comes in the back of very benign credit cost environment, and that is expected to continue despite rising rates over the course of the next 2-3 quarters.
1 minute, what did you say? MFI earnings also have improved. In that case, Bandhan should also benefit. No, why is it a miss?
Of course. Of course. I mean, okay, so Bandhan had that issue of near-term floods and, restructured portfolio, but slipping into NPAs, and those kind of issues are specific to Bandhan. So it's a very Bandhan-specific issue rather than, say, a general microfinance issue. Then, yeah.
Fair enough. Okay, the one that is missing in your list of forecasts are PSU banks. I mean, BOB has found its way into several, brokerages, and including foreign brokerage analysis. Would you extend? I saw SBI in your list. Would you extend coverage to other PSU banks? Do you have a positive stance on any of them?
Okay, so largely, I think, Lata, it makes sense to stick with the large PSU banks, both SBI and BOB. Of course, we cover both of them. We've actually largely dropped coverage of the other PSU banks. But having said that, I do believe that this may not be a short-term call or a near-term call, but over the medium to longer term, I do believe apart from SBI, all the other PSU banks would be candidates to the large PSU banks. I'm talking about like an PNB or a BOI or BOB for that matter, could be candidates who will be forced to acquire some of the weaker PSU banks because I really don't see them getting privatized. So that risk, obviously, some of these other PSU banks carry.
Okay. No, my apologies. There is Bank of Baroda in the list as well. Now, let me come to NBFCs, Suresh. You know, the one that we got, Canfin, there you actually saw margins falling. Do you think this is a quarter, or even a year when banks will grow at the expense of NBFCs? Are NBFCs as good buys for you as banks?
No, not at all. I mean, if you look at it, today, Lata, the deposit growth in the system is running way below loan growth. And if you look at some of the LDR ratios of banks at this point in time, they're really at the peak levels, right? You're talking about 88, 89% for HDFC and ICICI and others. LDR is almost to the limit that you can touch. So my point here is without an aggressive expansion of the deposit base, it becomes very difficult to get the loan growth. And therefore, and we're heading into a seasonally tough second half in terms of liquidity and the festive season coming in. It means that you're going to see further significant rise in deposit costs, which actually means the funding environment for NBFCs is only going to get tougher. You've already seen what's happening to the commercial paper rates, right? It's gone through the roof. The yield curve has flattened, and you are definitely seeing very tight liquidity conditions. In that environment, the NBFCs are going to face margin pressures. We do believe that the consensus is still very sanguine with respect to the margin expectations of NBFCs, and there can be downside risks from current levels.
Okay. Well, the one way of looking at the deposit growth not keeping pace is that a lot of FPI money has been pulled out. In April, May, June, it was huge. July, August replenished a bit, but again, September, we have seen outflows. These show as deposit falls in the banking system because the money gets pulled out. So should we worry so much about deposits? After all, banks seem to have enough unused, excess capacity in SLR and CRR, which they can draw down. So short point, the question is, can they improve margins even in Q3?
Okay, so if you were to really take a view on margins in Q3, definitely this got further tailwinds because remember, banks are asset sensitive, right? And we are very clearly arguing that the RBI is not going to stop hiking repo rates. I mean, they've already hiked by 190 basis points, maybe another 50 basis points, which will start flowing in Q3. And therefore, banks will continue to see margin expansion. But that is more got to do with the lead lag issue between lending and deposit rates, right? So the loans reprice faster than the deposit, and therefore you see an immediate tailwind coming to margins. My problem is not necessarily the FII flows affecting deposit growth. I don't think that's the main reason. The problem also here is because the dollar is strengthening. The Reserve Bank of India is forced to intervene heavily in the FX market. So they are actually selling dollars and sucking out rupee liquidity. And that's actually causing a significant proportion of what I would say pressure even on the overall deposit growth at this point in time.
I take your point. There is a liquidity issue, certainly, and the Reserve Bank stated policy itself is removal of accommodation, which is removal of liquidity. So that is going to happen. Okay, separately, you do expect margins to improve. What's the pick of the pack in the NBFCs? For you, it is second to banks, but would you still have buys?
Yes, so we are definitely positive on SBI cards at this point in time. So the way we are looking at is that the NBFCs which have pricing power and they run a very high yielding model. To some extent, you can even put Chola also in that category where clearly there is some pricing power in certain segments with the recovery in the commercial vehicle segment and stuff. So yeah, so it's better to stick with these quality NBFCs. Again, this could be more longer term rather than a shorter term tactical call. Clearly with the rising rates, the preference is more towards banks, but SBI cards and Chola will fit our requirements when it comes to our picks in the NBFC space.
Not Bajaj Finance.
Sorry?
Not Bajaj Finance? I mean, I would have thought that would be in your list, no?
So we actually have a very counter consensus call of a sell rating on Bajaj Finance. We are of the view that obviously valuations are getting priced for perfection. And I think the option of them getting converted to a bank, which I think is just a matter of time rather than if, it's a matter of when rather than if, the market is still not pricing it at 7 times price to book. The market is very clearly indicating that they would never get converted to a bank, which we strongly disagree. So eventually it has to get converted to a bank which will dilute its return ratios.
Okay, yeah, that could happen also because I guess Bajaj Finance has nothing much to do with Bajaj Auto. The two managements behave extremely autonomously, so maybe it'll come. A final question on HDFC Bank, Suresh. What explains this continued underperformance even after what I would think are very good numbers? Is there still some worries with the merger?
Yeah, I mean, that is a single biggest point of concern. So actually, we had taken the HDFC Bank senior management on a roadshow about a month ago. And we met around 40-50 investors across Singapore and Australia. And the single biggest question was on deposit growth. So let's look at the conundrum in this way, right? You're talking about HDFC Bank growing its deposit base at 19% this quarter on a YOY basis. And the loan growth was at 20 to 23%. So that thus takes care of the overall their own intrinsic loan growth requirement. Now you add HDFC Limited to the balance sheet. On top of that, you have to grow 20%. And on top of that, you have to replace the entire liability balance or a significant proportion of the liability balance of HDFC Limited, which means your deposit growth requirements are going to be even more onerous post the merger, right? And that's getting to be a big challenge at this point in time and a big worry in the minds of investors as to how these guys can sustain such super high levels of deposit growth when the overall deposit growth in the system is obviously very sluggish.
Okay. Yeah, I guess those doubts can persist. But I think there is that 7-year infrastructure loan rule which Reserve Bank put in, I think in 2014 or 15. So a part of HDFC's loans need not be treated for SLR and CRR is my guess. But I mean, we will have to work out the numbers when the merger actually happens and what the Reserve Bank tells them. What would your top buys be at the moment?
Yeah, so our top buys at the moment is clearly HDFC Bank, ICICI Bank and IndusInd Bank. So these are the 3 top picks that we are pushing to the investors.
All right. Well, we'll continue the conversation after all the results are out. Suresh Ganapathy, pleasure speaking with you. Thank you very much indeed for joining us. The Bank Nifty has been cheering and is cheering even more after this chat, up 1%. And of course, Sensex and Nifty up 1.2. We wind up bazaar with the markets on a very strong footing. Chartbusters will take the action.